Okay, so is Canada's economy actually stalling out, or are we just looking at statistical noise? Welcome to The Explainer. Today we're cutting straight through the dramatic breaking news that Canada has slipped into what the media is calling a technical recession. Instead of just reading the headlines and panicking, we're going to look at the hard data. We're breaking down the math, navigating the global trade pressures, and figuring out if the situation is really as dire as it sounds.
Okay, let's dive into this. Negative 0.1%. That's the annualized rate at which Canada's real gross domestic product fell in the first quarter of 2026. I mean, it's a tiny, tiny fraction of a percent. You've got to ask yourself right off the bat, can a number this incredibly small really plunge an entire country of millions of people into a recession?
So what does a technical recession actually mean? Well, strictly speaking, the textbook criteria is met here. It's 2 consecutive quarters of negative economic growth. We're combining the downwardly revised 1% contraction in Q4 of 2025 with this new 0.1% dip in Q1 of 2026. Cue the R word, panic, right?
But, context is absolutely crucial here. The last few times we saw this label applied to Canada, it was during massive, undeniable global disruptions. Think back. We saw it at the start of the 2020 pandemic when the entire world literally shut down. And before that, it was during the severe oil shock at the beginning of 2015. Today, in 2026, we're dealing with trade wars and tariffs. Compared to those previous historic, earth-shaking events, the current dip is incredibly mild. It's so mild that a lot of economists are questioning if the label even fits today's reality.
Now here's where things get kinda tricky. The real trick hiding in these headlines is the math itself. Annualized declines naturally magnify the data. They do this by projecting a single 3-month quarter's performance over a whole year. It essentially assumes the current trajectory isn't going to change at all. But when we zoom in on the strict quarterly basis, well, that tells a very different story. If we look at that raw, strict quarterly basis, the economy sat at exactly 0.0%. Completely flat, unchanged. By flatlining, Canada mathematically skirted a true quarter-on-quarter recession. Those doomsday headlines you're seeing are relying entirely on that magnified annualized math to paint a much darker picture than what the quarterly numbers are actually saying.
But wait, there's a massive paradox hiding in this first quarter data. While the overall GDP stalled, real GDP per capita, which is basically the economic output per person, actually went up. It rose by nearly 1 full percent. So how on earth is it possible for a country's overall economic engine to stall out while its per-person wealth actually increases?
And this brilliantly illustrates a really bizarre statistical quirk. It's like a giant puzzle. The economic pie isn't actually getting any bigger, there are just fewer people taking a slice. Following the population surges of 2023 and 2024, Canada actually experienced 2 consecutive quarters of population decline. Because there were literally fewer people in the country, the per-person economic data artificially skewed positively. It completely masked the fact that the broader economy was, in reality, struggling to grow.
Section 1, drags versus bright spots.
So let's dive into the actual moving parts. What's dragging the economy down? Well, Statistics Canada flagged a few specific things. First, a surprisingly high level of gold imports pulled the overall numbers down. Second, resource extraction had a particularly weak month in March. Third, and this is a big one, business capital investment has been dropping for 5 consecutive quarters now. That's a major sign of corporate hesitation. And finally, government capital investments fell steeply. We're talking a 2.5% drop in just the first quarter alone.
But hey, it's not all doom and gloom. While some sectors definitely dragged, we actually saw some vital bright spots that provided a much-needed cushion. Businesses aggressively hoarded their inventories. Everyday households actually increased their spending. People were opening their wallets more for things like financial services and food. And despite a very tough global environment, shipments of crude oil and natural gas increased, providing some serious energy to the Canadian export market.
Section 2, the political blame game. Now, whenever economic data turns negative, the political temperature absolutely skyrockets. On the domestic front, Conservative leader Pierre Poilievre places the blame squarely on internal policies. He points the finger directly at Prime Minister Mark Carney and his administration. By calling it a liberal recession, this perspective views the economic stall as a direct result of internal government management and domestic policy choices made over the last decade.
On the flip side, financial analysts are looking outward. Doug Porter, the chief economist at BMO, states that there's little debate the economy has struggled to make headway amid the ongoing trade conflict. From the economist's perspective, it's the external global pressures and international market dynamics that are the primary culprits holding Canada back, rather than just domestic policy.
Building on that global picture, economists are pointing to a few big external factors. U.S. tariffs are hammering Canadian passenger vehicle and light truck exports. At the same time, the war in Iran is spiking energy costs and creating massive global uncertainty. Because of these general global trade war dynamics, organizations like the Canadian Federation of Independent Business say owners are essentially stuck in a holding pattern. They're pausing investments while they just tread water and hope for brighter days ahead.
Section 3. What happens next?
Looking at the immediate horizon, there's actually a significant glimmer of hope. Statistics Canada released a flash estimate for April, showing economic growth bouncing back sharply by 0.4%. This was driven by a return to growth in mining, quarrying, and oil and gas. This early data suggests that the trade-induced stall might already be reversing. In fact, some economists are even going so far as to call this robust growth. Meanwhile, all eyes are on the Bank of Canada. For 4 consecutive meetings now, they've held the overnight interest rate in a static holding pattern at 2.25%. They are locked in, walking a really fine line between the inflationary risks of higher energy prices and the glaring weakness of the domestic economy. And this matters directly to everyday Canadians. It dictates everything from your mortgage rates to basic borrowing costs. So the crucial point is that this incredibly weak Q1 data essentially washes away any argument for further rate hikes this year. Financial markets are pricing in a near 100% certainty that rates will just hold steady. As economists have noted, the Canadian economy is simply in no condition to deal with the pressure of higher borrowing costs right now. Which leaves us with one final, really provocative question to think about, factoring in the flat quarter, the population decline, skewing the data, the global trade wars, and all the political finger-pointing. Is this technical recession just a statistical mirage magnified by annualized math? Or is it a real warning sign for Canada's fragile future? It's a powerful reminder of how complex economic labels can truly be. Keep questioning the headlines and keep learning. Thank you so much for joining me for this explainer.